And the reason is that there is this mean reversion in return on invested capital. So Michael Mauboussin has tested this. He's examined a number of the 1,000 largest listed stocks in the US, ranked them in order of return on invested capital, and then divided them into 5 groups. So the very highest, and then he's ranked them into very highest and the very lowest. And then he's examined those same companies 10 years hence. And what he finds is that the highest return on invested capital mean reverts towards the mean return, and the lowest return on invested capital also slightly improves. So I think of the highest return on invested capital as being Regno at the very peak of the wheel and Sumsino Regno at the very bottom of the wheel. So what is the acquirer's multiple? Well, it's the enterprise multiple. The reason it's called the acquirer's multiple is it's the metric used by leverage buyout firms, private equity firms, activists to look through into the hidden value of the business. And in terms of the mechanics of it, it's market capitalization plus debt, because the business has to fund the debt. You're able to use the stock. You're able to use the cash to pay off the debt. You're also liable for the preferred stock. You're also liable for any minority interests and underfunded pensions, off-balance sheet liabilities. So it's the real cost to buy the business. And then you get access to EBITDA or EBIT, which is the cash flow coming in. It turns out that it doesn't really make much difference which you choose. But when we tested them using data from 1964 to 2011, so we tested a variety of different possible metrics. Earnings yield, which is the inverse of the price earnings metric, just to highlight the two. The acquirer's multiple using EBIT, the acquirer's multiple using EBITDA, free cash flow on enterprise value, gross profits yield, so that's just revenues minus cost of goods sold to give you the third line on the income statement, and book to market, which is the inverse of price to book, so that they're arranged in the same way. We found that the acquirer's multiple outperformed. And again, not just on a raw return basis, it outperforms on a risk-adjusted return basis too, and comprehensively. The 4 things that I want to take away from today are that the very deepest undervalued stocks outperform the highest quality and the highest growth, even in the undervalued portfolios. So undervalued portfolios divided into high growth and low growth. The low growth undervalued portfolios will outperform. So it's better to be assuming that there's going to be some mean reversion, positive and negative, rather than to naively extrapolate out the growth in earnings. Simple models applying these ideas will always outperform expert discretion. So at the beginning of your process, you decide what is important in the assessment of value, and then you rigorously apply that without fear or favour. And the acquirer's multiple is the best multiple. If you're looking for a very simple application, a very simple rule, this is a very good one.